Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, I'm gonna talk about MGM Resorts, okay, so the casino industry. I'm gonna do a fundamental valuation of the stock, okay, so leave me a like if you find this video interesting and subscribe to the channel and let's begin. Alright guys, so during those days it looks like that the market is going down a little bit, okay? So what we do when the market is going down, we don't panic and we continue to analyze businesses, okay? Trying to find good opportunities. So MGM Resorts, let's see, the stock went down crazy during the pandemic crash. And right now we are up a lot, okay, because from around 5.8 to 24 almost, okay, so it's huge. It's absolutely huge. And one can ask, where is the fair price? Well, we are gonna see in this video, okay? Now, before we start, I want to show you one important thing. The important thing is that when we go back in time, we can realize that MGM Resorts had a sort of a huge crash during the 2008 financial crisis, and since then they have never come back to previous levels, okay? We can see clearly from here, okay? This was the bottom of the 2008 financial crisis, around $1 per share, okay? So that's it, just to have in mind the price action. Let's start with the balance sheet as always to understand the current situation of the firm, okay? So now, sorry, this data here is wrong. This is March, okay? March, the 30th of March 2020. What we have a current ratio of 2.89, okay? 2.89. Which is absolutely great for an industry like casino during a pandemic, okay? Why it's so high? Because they have a lot of cash right now, okay? Almost 6.2 billion in cash. And this is important. I like that. Let's see total assets and total liabilities. We have a decent ratio of 1.52, okay? So it's great actually. And when it comes to debt to equity ratio, we have to distinguish between the two because, as I told you, they have a lot of cash aside. Okay, so if we do the debt to equity ratio, the simple one, it comes very high, 150%. But when we do the net debt to equity ratio, it comes actually below 50%, okay? 42.93%. The market capitalization at the moment is 10.1 billion, and that gives us a book to value which is below 1, okay? So the stock is still undervalued in terms of book to value valuation. Because it's pretty simple, the shareholders' equity in the balance sheet is 13.33 billion, okay, and the market cap is below that value. Simple as that. When it comes to revenues and earnings, we can see that revenues went up during the last 4 years, and that is positive. When it comes to earnings, anyway, we can see that there is a little bit of roller coaster here, okay? Why? Because this is typical of casinos industry. And I'm gonna show you why. As you can see here, we have the revenue from 2006 to 2020, okay? And we're going up great, okay? Overall, has been a positive trend. What's the problem with this industry? The problem is this, okay, is the net margin. And as you can see, here you have the zero line, okay? You can see here, this thing here. And the margin, sometimes it's positive and sometimes it gets negative, and sometimes it go up positive. It's not consistent, okay? Why is that? Because casino industry is not a consistent industry. And plus, they have huge buildings and huge things to maintain. So capital expenditures, they vary a lot depending on which year we are considering. Okay, So what's the result of this thing? Okay, the result of this thing is that when it comes to the beta of the stock is very high. Okay, it's a high volatility stock. It's very volatile. And so to do our valuation, what we do, we try to flatten this attitude, okay? And I'm gonna show you how right now, because it's not possible to forecast exactly free cash flows for the casino industry because they are not very consistent. Sometimes they are super high and sometimes they go low. It doesn't matter the earnings. Even if earnings are going up, when it comes to free cash flows, it can happen that sometimes they are high and sometimes they are low. Why? Well, it's simple as that. Okay, look at that. It's very simple. When it comes here, even if you have high earnings, you're gonna have low, almost negative free cash flows. Okay, but the year later, guess what? It's completely a different situation. Okay, so this is why it's not very easy to get an understanding of those companies' valuations. Okay. Anyway, we are trying to do it, and how we are trying to do it. Let's take a look here. Now, this is what I was explaining you before. Okay. Look at that. For example, here we have revenues. Okay, so revenues overall has been growing, and this is positive. Okay, look at that. Pretty consistent actually from 2016 to 2019. We started with 9.45. We end up with 12.9. Okay, which is very huge. But look at that. When it comes to net income, this is what I was explaining you before. We start in 2016 with 1.1 billion out of 9.4. Okay, and 2 years later we have revenues a lot higher than 2016, but when it comes to net income, look at that, it's just 0.46, okay, billions. So very lower than the previous years. Okay, so that is why. So of course, when it comes to calculating this, we can see that they are not consistent. Okay, you have some years you have loss, some years they are very low, and the year after it's above 1 billion. Okay, so how am I gonna continue to do this valuation? Well, I take averages of those datas here. Okay, I take 40% in free cash flows divided by net income, and I take an average of net income margins of 12.68. So what is the fact here? The fact here is that I'm gonna find free cash flows that are consistent. Okay, so it's like I don't consider the extremes. Okay, so for example, I will never find a free cash flow of 1 billion, and I will never find a free cash flow too much low. Okay, so we can find a fair price. But remember, the fair price, it makes sense. But what you have to remember is that the stock, it's very volatile. Okay, so even if we find the fair price, and it makes sense to find the fair price in that way, but you don't have to forget that the stock continues to be volatile because the industry itself is volatile. Okay, so bear in mind that. Perfect. Now everything is clear. Let's continue. Now analysts are saying that, as we know, 2020 is not going to be good. Okay, we know that. And they are predicting a crash in growth of revenues of almost 50%. Okay, so 2020 estimated revenues by analysts are 6.5 billions. Going to 2021 with a comeback, okay, near the previous levels at 10.39 billion. Okay, and after that it comes our scenario analysis. Why? Because as always, we start by taking growth rates. Okay, so from 4% I took until 10%. Okay, and here it comes all of our scenarios. So we start with 4 and we go to 10, and let's see what we get. Now, before I consider 2 more scenarios. So this is what I call the conservative scenario. What the conservative scenario says, well, we take the first 2 years as estimated by analysts. Okay, and this year they're gonna have a loss, and we know that. Okay, we all know that of minus 0.8 billion dollars. Okay, and in 2021, 0.32 billions. Okay. Now, what is the difference in this scenario comparing to this one is that 2022 I took a lower free cash flow, okay, so a slower comeback for Las Vegas, okay, so 0.45 billion, and going to 2023 and 2024 like that. The rate of return is 10% due to the very high volatility. Okay, this should be probably even higher than that. Perpetual growth is 3%. What we have today's company valuation of 6.37 billions divided by the total amount of shares outstanding. We get a fair price of 12.94. Okay, perfect. Now, the normal scenario, why? Because it's the same as here. I just increased the perpetual growth to 3.50%. So in this case, we get a fair price of $13.89 per share. Okay, perfect. Now we start with all of our scenarios. So 4%, and for all those scenarios, I'm gonna consider 2 things. The 4% with 3% of perpetual growth and with 3.50. Sorry, here is, let me, 3.50. Perfect. Okay, so that's it. 3 and 3.50, and we increase the scenario 3 and 3.50 again. Okay, so let's see. 4% scenario, 3% perpetual growth, 13.10 as a fair valuation. Okay, when we increase the perpetual growth, we get a today's company valuation of 6.92 and the fair price of $14.05. Okay, now we increase 5%, and what we get, again, 3% perpetual growth, we get a fair price of $13.48 per share. Okay, again, 3.50% as perpetual growth. The today's company valuation is 7.12 billions divided by the total amount of shares outstanding. We get a fair price of $14.46 per share. Okay, now 6%. Okay, 6%, same requirements, 3 and 3.5, and we get respectively a fair price of $13.88 per share. And when we increase the perpetual growth, we have a fair price of 14.88%. Okay, now 8% scenario. So here we are going into a more optimistic view. Okay, this 8% means that basically when you go there and you change this, it happens that the first 2 years are fixed. Okay, those things are fixed. Analysts' estimates. So this 8% is telling you, well, revenues are going to increase at an 8% rate in 22, 23, and 24. Okay, so look at that. 8% means that in 2024, the casino industry, MGM Resorts specifically, is gonna come back to do the same revenues as they were making in 2019. Okay, a little bit more. Okay, 13 billion. And when we see, for example, the 10%, here we are. Okay, that's what we have. Now let's see the fair prices of that. Requirements are still the same, 3%, 3.50%, and a 10% as discount rate. So the first one, 8%, we get a today's company valuation of 7.23 billions and a fair price of 14.67, okay? And by increasing the perpetual growth, we get a fair price of $15.74 per share, okay? And the last scenario, 10%. In the 10%, 3 and 3.50, we get respectively $15.51 per share. And the last one, we get a company valuation of 8.19 billions and fair price $16.64 per share, okay? Now, we are going to consider also the book to value price. The book to value price, as I told you before, is actually higher than the price in the market, okay? Because the book to value is below 1, so the stock is undervalued considering the balance sheet, okay? What we have, the book to value price is actually 27.05 dollars per share, okay? How do I find it? Well, it's pretty simple. You go there and you take this stockholders equity. This is total assets minus total liabilities, and it should be the market capitalization if we are considering the balance sheet's values, okay? So you just take this and you divide this by the total amount of shares outstanding. And what we get 27.05, okay? So now we have 13 prices, and we take an average of all of those, and that's what we get. The fair price today for MGM Resorts is $15.41 per share, okay? When it comes to, we take a range, plus and minus 50%, and we get $17.72 per share and 13.10, okay? So the fair price range is this, okay? To have a number, single number in mind, consider this, okay? $15.41 per share for MGM Resorts, okay? So I did a video actually about MGM Resorts back in the days, okay? 3 stocks that I would like to buy, and I was telling you to buy basically MGM Resorts around $12, okay? So go to see that video if you haven't already. This is why I was telling you that, okay? And actually I bought MGM Resorts around that price, okay? Now let's see what the market is gonna do in those days, okay? Looks like we are having some trouble here. Probably is just a hand of a monthly cycle or things like that, okay? The market cannot go up forever. But as always, we continue to do our analysis and we don't panic. We look at real numbers and we try to find bargains, okay? So I hope you find this video interesting. Leave me a like and subscribe to the channel, okay? Leave me a comment below. Tell me if you have MGM Resorts and if you like this stock or not, okay? Have a wonderful day, guys. See you in another video.